So open that particular question. It says, and I read, okay. We are going to read it. Hii kiwepo kwa ile karatasi ya classnet inakuwa mingi. Leo inaweza kutokesha. Ukiangalia hiyo additional information. Today this one has been compressed. H Limited is the parent entity of a group of companies with two subsidiaries, S Limited and R Limited. Both subsidiaries have been owned for a number of years. So a number of years, it means there is none which was acquired during the financial period. The following statement of profits or loss and other comprehensive income relates to the group of companies, as our eyes is capable of seeing. On 1st May 2017, H Limited acquired 75% of the ordinary shares of S Limited, a public limited entity. The purchase consideration was cash of $560, and the fair value of the net assets of S Limited was 400 million as at that date. The fair value of the non-controlling interest in S as at the date of acquisition was shillings 240, I think to 40 million. H Limited wishes to use the full goodwill method for all acquisitions. Of course, they must use full because MCI already stated at fair value. The ordinary share capital and retained profits of S as at the acquisition date were shillings 100 million and shillings 200 million respectively, and there were no other reserves. The excess of the fair value of the identifiable net assets at acquisition is due to an increase in fair value of plant, which is depreciated on straight-line basis, and had a 5-year remaining life as at the date of acquisition. So you remember evaluation? Yes. H Limited had acquired 80% of the ordinary shares of R on 1st May 2016. The purchase consideration was cash of shillings 600 million. R Limited's identifiable net assets had a fair value of shillings 550 million, which was equal to their carrying amounts. The non-controlling interest of this. The non-controlling interest in R Limited had a fair value of 150 million at the date of acquisition. Good. Number 3, hapa kumbe ni mingi na inasonga. Si so far kuna kitu kinatushika sana. Ama si ile kizungumzia ya kawaida ya kila siku. 3, on 1st November 2019, H disposed of 30% of the ordinary shares of R Limited for a consideration of how much? 375 million. R Limited's identifiable net assets were 675 million, and the non-controlling interest of R had a carrying value of 175 at the date of disposal. The remaining equity interest in R held by H had a fair value of 575 million. After disposal, H would exercise joint control over R. Initially, they had acquired what percentage in R? 80. They have disposed of 30, remaining 50. So that is why they are saying they will exercise what? Joint control. So it has become a joint venture. The profit and loss of R are deemed to accrue even over the years. Nothing serious there. H Limited sold inventory to both S and R at a price of 150 and 45 million respectively in the year 2019. H Limited sells goods at a gross profit margin gross profits, margin of 20% to group companies and third parties. At the year end, half of the inventory sold to S remained unsold, but the entire inventory sold to R had been transferred to third parties. So UPI will only arise in which one? S. Because the other side, they had sold everything. So there is nothing like unrealized profit. That one is okay. Goodwill arising on acquisition had been tested for impairment annually, and as at 30th of April 2019, goodwill on acquisition of S had reduced in value by 15% and 30%, and as at 30th April 2020, had lost a further 5% of the original value. No impairment had occurred in respect of goodwill of R and the interest in R. No problem. Required. So we are on the required straight. Gain or loss arising on disposal of R to be presented on the consolidated statement of profit or loss and other comprehensive income. So this one they want consolidated. Gain or loss, I told you they are calculated in two ways. There is one in the individual books and in the consolidated. So here they want consolidated. Then they want consolidated statement of profit or loss and other comprehensive income for each group for the year ended that. Correct. So before we start that, I want us to check. I want us to compute goodwill. I want us to compute goodwill. It will be very important when calculating the gain. So allow me to start with goodwill computation first. So right there, goodwill. They want us to calculate goodwill. I want us to calculate goodwill in S and R. Of course, on the dates of acquisition. Goodwill on the dates of acquisition. So S Limited and R Limited. Shillings are in millions. So you start with the purchase consideration. So purchase consideration. How much did we invest in S? That should be note 1. 560. What about R? R is in note 2. I think the 600. 600. Then you bring fair value of NCI. So fair value of NCI. So fair value of NCI for S 240. How about R? 150. Therefore, here we are reporting how much? 8. Here, 750. Call it A. Call it A. Then you less net assets acquired. So net assets are the what? Equity components. So go to note 1. The purchase consideration was that and the fair value of the identifiable net assets of S was how much? 1. So how much that money? So fair value of net assets is 400. And the other one, not 2. Identifiable net assets at a fair value of how much? 50. So goodwill is the difference between A and B. This is 400. How about this? Huh? 200. I proceed with impairment. Impairment is mentioned in note number 5. Note number 5. Goodwill arising on acquisition has been tested for impairment annually. And as at 30th April 2019, when we are in which year? Kindly check our year of consideration. 2020. So the one they are talking of 2019 is those years. Goodwill on acquisition of S had reduced in value by 15%. So it had reduced in value by 15% in those previous financial periods. Fine. And as at 30th April 2020, where we are, had lost a further 5% of the original value. So that is S. Then no impairment had occurred in respect of goodwill of R. So less accumulated. Accumulated what? Impairment. Accumulated impairment. Accumulated means before this year. Before this year, they said what percentage? 15%. So 15% of 400. 15% of 400, how much is that? 60. So 60. So this is 300 and what? 40. Then for this year, yes, for this year, you say less impairment for the year. So impairment for the year 2020, they have said 5% of what? Of the balance or of the original? Original. So 5% of 400. 5% of 400. How much is that? Hmm? 20. So an impaired goodwill hata ningewasha hii sishuke mpaka huku chini. An impaired goodwill, how much? This is 320. But this one was not impaired, so this is 200. So if at all we are required to prepare the balance sheet, then this is what we take to the balance sheet. Then this is what we take to P&L, the 20. Which this 20 we are going to classify under which expense? The impairment will be classified under administrative expenses. So there is something I want us to check. Net assets. I want us to check the net assets. Also the yeah, I want us to check net assets of S because there is revaluation on a feature. Maybe we will require it later. There's revaluation being hidden somewhere. So write for me there, net assets on acquisition of S. on acquisition of S. They are not coming out clear in that note 1 on the revaluation, but we can get. How do we get net assets? You take ordinary share capital. How much is the ordinary share capital? This is in note 1, all of them are there. Note 1, paragraph 2. The ordinary share capital and retained profits of S at the acquisition were 100, and retained earnings is how much? 200. And there were no other reserves. Okay. The excess of the fair value of the identifiable net assets of acquisition is due to increase in fair value. So fair value uplift, which is revaluation. So revaluation is our balancing what? Figure. Then total net assets, which they are giving, check paragraph 1 of note 1. Total net assets, they're saying is how much? 400. Yeah? Yes, they gave us this one here. They told us the net assets total is 400. So they are saying the difference between what we have and what they are giving is revaluation. So revaluation is how much? It's 100. Someone not one year to tell what we are saying. Is that clear? Is that clear? Yes, that is very much clear. So maybe if we will leave it, fine, no problem, we will capture. Now later. All right, let's go to required now. I think we can do the required without any problem. Required Roman 1, they want us to get gain or loss arising on disposal. I don't know. Should we, though not required, but should we do the two gains? You know, there is gain in the individual books and gain on the consolidated. Here they want consolidated. Can we just do that other one, individual books for fun? Like if I'm unaenda straight. So, so let's have gain on disposal, gain on disposal in the individual financial statement of the parent. So that one is always the easiest. Gain on disposal in the individual financial statements. The individual financial statements. So in the individual financial statements, the parent will say how much was the proceeds. So you just consider proceeds on disposal. Proceeds on disposal. How much did we receive when we disposed the subsidiary? Iliuzwa pesa ngapi? Note number 3 is talking of everything. So read note 3. For a cash consideration of 375. Then the parent will subtract their net assets which they are selling off. So less, not net asset, but investment. Less investment disposed. Investment disposed. Investment disposed. You check what was the cost of investment. How much did parent invest in art? It was 600. Yes, this one here. They invested 600. But of the 600, 600, they have disposed what percentage? Sure. Are you sure they have disposed that? They had invested how much? 600. You have to be very keen. Initially, check here. Parent was having was controlling what percentage in R. They are controlling 80. They disposed and they are remaining with how what percentage? 50. Sure. You know 80%. 80% is 100% holdings. Your 80% is your 100% shareholding. So if they are remaining with 50, that is what fraction of the holdings. You need to be very keen at that stage. Will it make sense? 62.5. So it's like 62.5, meaning those people disposed of what percentage? It's 37. They disposed of 37.5% of the shareholdings. You know, check here, it's simple. I don't know if this one can work for us better. Let me just say over 80. 5 over 8. They disposed. This sounds better. You need to be very cautious. Otherwise, you'll get it wrong. They're remaining with 5 over 8, 50%. They have this, no, they're remaining with this because they disposed. It is the same. Yes, 3 over 8 times 100, just the 37.5. I want the one which makes one easier. Senior? Yes, they're remaining with this one here. So, no, they disposed this, they're remaining with this. So they disposed 3 over 8. They disposed 3 over 8 of the investment. Yeah, they disposed of, no, Terry, you are saying it vice versa. They disposed of 37.5, then remained with 62.5. Because we are remaining with 50%. So don't just say 30%, because you see it is 80 minus 30 to get what? 50. You know 30% of 80 is not 50. So you can know what I'm trying to say. You know, Mukisema, they disposed 30%, then it means they disposed of 30% of what? 80, which is wrong. So they disposed 3 over 8 and remained with the 5 over 8. So how much is that? So 3 over 8 times 600. That is what they disposed. They disposed of what value? 225. So in the individual books of the parents, you will talk of a gain of 150. So I repeat for those who have not understood. You know, when someone tells you that they were controlling 80, they disposed 30, and they remained with 50. So you cannot say that they disposed 30% of the holdings. You know, if you dispose 30% of holdings, it means 30% of what? 80, which is not the case. They had 80, then they are remaining with 50. So you need to check what percentage did they dispose. For them to remain with 50, what percentage did they dispose of? Which is the best way? This one or this one? The second one. Yes, they disposed 3/8 and they're remaining with 5/8. Work with that. That one is easier. Or you go the long process. 80% is your 100% shareholdings. What about the remaining 50? No, that one is will take you into circles. They remain with 5/8. They disposed 3/8 of the shareholdings. That one is easier. There. So 30% what is in it? So the remaining with umeelewa? So hiyo hata tu kuulizwa, so hata ifai kutusumbua. Let's go to what they want. They consolidated gain or loss, but that is how it is done. Gain or loss in the consolidated financial statements. I want to operate two columns like that. So again, you start with the proceeds. So proceeds on disposal. So proceeds on disposal, you have 375. Then you add the fair value. Add. Check the other format, what we did. We have the fair value of what? Fair value of net assets, done what? Retained. So add fair value of net assets, done what? Retained. Net assets retained. So I want you to read the entire note 3, then you tell me what we retained, the one which was not disposed. So read the entire note 3. How much, Dr. Huh? They retained, not, let me check. R limited identifiable net assets tax. The remaining equity interest in R held by H at a fair value of how much? 575. And that one comes to what? 950. Yes, that is 950. Then you less and impaired goodwill done what? Goodwill disposed. And impaired goodwill disposed was how much? The goodwill which we computed in R. R had a goodwill of how much, which was not even impaired. It was 200. I have it somewhere here. It was 200. Then you less net assets. Net assets disposed. What was the value of the net assets in R on the date of disposal? R on the date of disposal. R on the date of disposal. In that same note. What is disposed that for consideration of this? R limited identifiable net assets was 675 million. So on the date of disposal, 675. There was no dividends which were earned. So can you add this? But I'm seeing in this question they are bringing something which will be considered. So this is 875. In the same note 3, let's read note 3 once more. On first base, H disposed 30 of R for how much? For 375. R identifiable net assets is 675. And the non-controlling interest had a carrying value of how much? 175 at the date of disposal. So it means R, they were also interested, unlike Elizabeth and Guinea, R were also interested in the fact of net assets. So if there were no fair value of minority on the date of acquisition, I'll go and subtract that one straight. But now in this case, date of disposal, I mean, less fair value of NCI on the date of disposal. On the date of disposal, they are also interested. They are interested in the net assets, and therefore we will subtract of the net assets which the parent is talking about. NCI had also a fair value of the date of disposal, so that one we have to net off 700. Therefore, in the consolidated, we shall report again of how much? 200 and what? Simple as that. Hiyo ni max gapi? 4. Huh? Si lazima zikuwe the same. Yes, but mostly they're the same, but not a mass. Okay, good. Let's talk about the same one. 1, 2, 3, 4, 5. Asa, utatoka bure kwa hii game. Because you know these people are likely to examine disposal, by the way. Wakikuuliza again, utatoka bure. Ni gani utatishikilia liwe liwalo? Proceeds. Proceeds only. Na hii pia itakuwa labda goodwill, kama goodwill itakuletea shida. Hii pia itakuwa this one. This one can miss. So if it's there, fine, toa. So you should be able to get these ones. 1, 2, 3, 3 apple. Those ones you should be able to get. All right, let's go to the next. Next is consolidated statement of P&L. So consolidated P&L, you need to analyze. You analyze the question. And this is now something I want you to do for me. I want you to analyze the question. You tell me how we are going to do. You know, this is P&L. Very tricky. You tell me how I'm going to consolidate for H, S, and R. Do I add them in full, or what will happen? So I want you to come up with your own number line, draw the financial year, analyze those subsidiaries well, plus the parent. Then you tell me H will be this, S for this month, R for this month, or in full. Like, I'm giving you exactly 5 minutes. So, Siwarakishi, online you can just write. Once you are sure, you just say it will be, do for me the two, though balance sheet was not requested here. But I want you to do for me even the balance sheet. You show me that P&L will be this plus this plus this. Balance sheet will be this plus this. Ukishapata your analysis, hiyo swali utapata. You will get what the normal stuff you'll be able to do. That is where the question is. So can you analyze, draw the financial period, analyze it well, then tell me those two, how we'll go about the two. Sasa swali ndio hiyo. So wacha nione what people have to say, then we compare notes. Dispose, not. Martha, P and L, H plus S. Martha, hiyo rakati ni siyafanya hiyo yesi ingiana. P and L yesi ingia H plus S. Paswell, P and L will be H plus S plus R times 6/12. Then P and L, H plus S only. Balance sheet, yes. Balance sheet is H and S only. So first of all, what wanakupigia kura? What was the question? Terry. So mother, you change P and L, H plus S plus that one, that's okay. How are you getting the 6 months? I am getting more than 6 months. Hussein is getting more than 6 months. How many months are you getting? 14? Or how many months? Oh, you have seen it. So what is your conclusion? H plus S? Huh? So when is the financial year ending? April 20. So this one starts on 2019. When did we acquire S? S was acquired in 2017. So S is full year. So S is a full year. Full year subsidiary. R was disposed when? First November 2019. That is when we were controlling 80. Then it came to 50. So 50 is a joint venture. We don't need joint ventures. So from here to here, how many months? 6. So R 6 months subsidiary, 6 months JV. So P&L will be H plus S plus R times 6/12. I think that one we got. Then consolidated statement of financial position will be H plus S. So R, you will only determine investment in joint venture. Full stop. What do they want in this question? The P&L. So this one here. You are safe to go. So let's start. This is the heartbeat of the question. Yeah. So someone can put that one down. So right there, H group. So H group. Another comprehensive income. These are other comprehensive for the year ended. Hata hiyo tumefanya tushamaliza hiyo swali. Hiyo ndio hata mnaimalizia. Year is ending when? 30th April. We are even done with the question now. We are done with the question. That analysis is the question itself. Hata kama mtu alikuwa na hiyo karatasi, just 30 minutes to exam akwambie hiyo, ameshakutengeneza. HSR 6 months, full stop. So you know now the presentation now becomes easy. Lakini hatuna karatasi. Shillings are in million thousand. So let's kick off. Revenue. So revenue 4275 plus S 25, 15 plus R 17, 30 times 6 over 12. Was there intergroup sales? Note number 4. H sold inventory to both S and R at a price of 150 million and 45 million. Then kuna story ingine hapo mbele. But for revenue, subtract all. So, intergroup sales here we consider to be how much? 150 plus that is 195. Yes. All right. Whatever they sold internally, those ones we should eliminate on consolidation. So can you consolidate and tell me how much? That comes to 90. 24. 2460. Okay. So cost of sales. Cost of sales will be 2735 plus 1445 plus 1010 and 10. Subtract again, but now this is 6 over 12. Subtract again 195. Add back unrealized profit. Can you calculate for me unrealized profit in note number? Why is this not note number? It was note 4. Yes, in that note 4. Can you calculate the unrealized profit in note 4? So note 4, they sold that H sells goods at a gross profit margin of 20%. So it is 20%, that's margin direct, you don't have to convert. Times at the year end, half of the inventory sold to S at remain. So half of what was sold to S, they sold 100 and what? 50. So 20% of this, 30.
Yeah, so
20% of 35. 15. Yes. So our realized profit there is 15. Work back 15. So that is UPI. UPI is 15. Then, as you progress, they are saying but the entire inventory sold to R had been transferred to third parties. So there is no UPI there. You know, so the sale value becomes the cost. Then there was depreciation. There is depreciation somewhere. So there is depreciation issue in note number 1. Check note 1. Additional information number 1. Paragraph 2 of note 1. Paragraph 2 of note 1. The excess of the fair value of the deferred net assets at acquisition is due to an increase in fair value of land, which is revaluation. Sure. Which is depreciated on straight-line basis and had a 5-year remaining life as at the date of acquisition. So revaluation, we got how much? So that revaluation is what we divide by 5 years. It was 100. Eh? Yeah, revaluation we did a working. I can still see it here. We got 100, and the 100 is being depreciated over how many years? 5 years. So you divide by 5 years to get depreciation per annum. How much is that? 20. So depreciation per year, 20. Classify that one here by adding You add depreciation as part of cost of sales. So this is UPI, this is depreciation. Those two. What do you get? 45.25. Therefore, gross profit gross profits yes 29.35. So 29.35. Then there was gain on disposal of R Limited. You bring it as an income in P&L. So the consolidated, whatever the individual, we got another part. The consolidated, we got 250. Yes, we got 250. Then joint venture, you share their profit after tax. So you say share PAT in JV. So which company became JV? R. So check the profit after tax of the JV, that P&L. So profit after tax, are you saying 380? So we'll take 50% of the 380, but it was JV for how many months? 6 months. 6 months. 6 months. So that's how much? 95. Eh? You can add if you want, but you can just proceed. What do you think? Should we add? Yes, let's add, then we proceed. How much? But not a must. You can even proceed if you want. How much is that? 32.80. Then we have distribution. Distribution, just add. There is no working. So distribution is 305 plus 195 plus 90. 96/12. How much? $545. Then administrative, you add 370 plus 235 plus 120, 6/12 plus what? Impairment. So impairment check for the year, not accumulated, for the year. It was 20, yeah? Yes, impairment for the year was 20. Check where we calculated goodwill. So impairment was 20, where we did goodwill. How much is that? 690, 85. 685. Then profit from operations is still a must. So, operating profits. You know what is an operating profit? How do we call operating profit in finance? What do you want to FM? Operating profit in FM, you break you what? Earnings before interest and tax. Which here we call it profit before interest and tax. That is the operating profit. Impairment affects goodwill. So goodwill is also an intangible asset. So tumetoa hata kwa goodwill, je tupate net goodwill. Tumetoa. O kama ziko, mostly unapata kama kuna intangible assets, to separate them. Examiner anakuambia goodwill is impaired by this, then wanaenda wanakuambia intangible assets are amortized. Utapata wanasema amortization if the two of them are there at the same time. But kama kuna goodwill, wanakuambia intangible assets are impaired. But rarely do they talk of impairment of intangible. Intangible assets utasikia wakisema, you know, intangible assets are classified into goodwill wanajaribu kukua peke yao. Then these others, they are called intellectual properties. The copyrights, the patents, the use we amortize them. Rarely do they talk of impairment of intangible. Impairment mostly applies to goodwill. Then these other ones we amortize. So what is your main problem? How much you thought? There was amortization of intangible assets. What impairment? Even you, they can say you have been impaired. So see at impairment, kila siku lazima kuweke kitu ya. They have to be specific. Or impaired or amortized. So they have to be specific. See at ukiona tu hapa unaenda kuitoa. In fact wakisema hata ufai kuishughulika nayo. You just expense and that is it. So how much? 2050. Finance cost. Finance cost, you add 45 plus 40 plus 30 times 6 over 12. How much is that? 100. So you get PBT, profit before tax. So the only thing which is difficult in this question is the time period. Your time ukipata hivyo venye umepata, you will see things we are going to get here. So PBT will be 90. Income tax. Income tax 160 plus 120 plus 100. 6 over 12. $330. So PAT 20. Other comprehensive income. Other comprehensive income. There is what? Gain on property evaluation Radical evaluation again. Just 150 plus 8. 150 plus 8 is 230. So total comprehensive. So you close it there. Total comprehensive income. Total comprehensive income. How much is that? 80. 50. Then now we want to share the profits. We want to share the profits. So I want us to share the profits. So right there, PAT, PAT attributable. Hapo tu chini ukisonga, ukimaliza hapo chini kwa P&L yako. Profit attributable to NCI, then holding company. So the total PAT from what you have given me is 1620. Then total comprehensive income to NCI holding company. Total comprehensive is how much? 18. So that is how we are going to allocate the profits. All right, so let's have a computation for PAT, which goes to the minority. So PAT to NCI, profit which goes to NCI. So NCI in S and R. In R, remember to give them profit for how many months? 6. For 6 months. So reported PAT. So reported PAT. How much were they reporting in their P&L? So check the P&Ls. Where's P&L? P&L, profit after tax. Are you seeing 480 and 380? So this is 480. This is 190 because 380 times 6 over 12. Because how? Yes. Then adjust the obvious. The obvious is UPI. UPI, you only subtract this subsidiary is the one who sold. Here, the parent was the one selling. So don't interfere with the profit of the subsidiary. Impairment, yes, it was full method. So less impairment. Less impairment loss. Impairment loss was how much? 20 for the year. 20. Depreciation, the subsidiary. Depreciation for the year was how much? Also 20. Yes, depreciation was also 20. Then there is nothing. NCI is adjusted with the depreciation, impairment, and unrealized profit. Yes, unrealized profit was there, but it was not the subsidiary selling. So don't interfere with their profit. So give me the adjusted profits. Give us the adjusted profits. Eh? This is 440. So this is 440. 440. Therefore, NCI for S parent was controlling what percentage? 75. So NCI will get 25%, comma. The other side NCI was getting, initially parent was controlling 80. So NCI to get 20. So get 25 of this, 20 of that. We go. So for 40 by 25, 110. So 110, 20% of 190, 38 is equals to this plus this to get the total. So 110 plus the answer, 148. So you go back, then you say PAT attributable to minority is 148. So it means parents will take the total PAT 1620 minus what? 148. So 1620 minus the answer 1472. Then we want to know the total comprehensive. Ngoja kidogo. Hussein is saying UPI was no. Yes, it was there, but do we subtract? No, it was a downstream sale. The sale was from the parent. So if the sale is from the parent to the subsidiary, you don't interfere. You only subtract if it was upstream. Upstream means subsidiary is the one who did what? Sold. So if you sell, your profit is being affected. So same kila siku ukiona UPI ni kutolewa. You only subtract if the subsidiary is the one selling. Alright. Then let's go to total comprehensive income. Total comprehensive, check our P&L, how it looks. How did we get total comprehensive? It was the sum of what? Huh? The total comprehensive of 1850 is PAT plus what? Plus the revaluation. Yes, so even here, the total comprehensive, for example, for NCI, will be this way, will be the profit after tax, which they have gotten one what? They have gotten 148, the PAT, because total comprehensive is the sum of PAT plus revaluation. So you take PAT, which is 148, plus revaluation. So revaluation in this case, well, at the depreciation imetoka wapi? Depreciation ilitoka wapi jamani? Online msaidie hapo Victor. Tell Victor where depreciation is coming from. I want to see how you are helping. So total comprehensive revaluation. Revaluation we had 150 plus what? 80. But NCI only take their percentage of what? 80. So NCI will only take their percentage of this 80. This one here. So it will be 148. Victor Boniface is saying, can you focus on note 1? So 148 plus 80. 80 times what percentage? Root times what percentage? 25. Yes. And 25% because it was in S. So 80 by 25 should give you 20 plus 148, 168. Then, so two things. If you want for parents, either we take this minus this, and then we go the other way. You take this minus this, you fix, or parent you will say from profit, they got how much? 14. They got 1472. Then I add revaluation in the books of parent which is how much? 150. Then for the subsidiary, the parent takes what percentage? 75. So I believe if you take this minus this, it should be the same with this sum. Which one do you want? I know. Ebu confirm, but it should give us the same answer. Ebu check to confirm. The evaluation was 100 divided by 5. So what, Victor, is that okay? I can see so many people coming to your rescue. Terry is coming to your rescue. Password to your rescue. Boniface. So Victor, have you seen what they're saying? Or I chip in? Is it the same? When you do all, I'm trying to find you example. Subtraction is sufficient. Victor, umeelewa? Because how much? 1680. Thank you. Good. So that is okay. So that is how that question is to be done. Was to be done. How many marks? Want to pay marks? 12. Assuming words for words, 1 for 1. Tell me things you will get without straining. On assumption that, but I'm assuming ulikuwa sawa, that umeapportion vizuri 6/12. Mtu aliona hiyo 6/12. What do you get? Yes. Steve, wewe unaona gani iweze kupita hapo kwa finance cost? One year evaluation ungeanguka ni si tungepata ama hiyo tungepata 1 2 3 share distribution. This one umekumbuka impairment hata hivi utapata this one. By the time unaenda mtihani, I know without struggling you will get this one. That one I'm sure. Even this one you will get. Share of associate joint venture PAT. Now that's straightforward. So someone who has not struggled should get 1, 2, 3, 4, 5, 6. Those are the things you can get without struggling. They will mark, then they realize students are not performing. It will be 6 times 2. What a mark wanapata, number 1, 30% of students have not done group accounting. The remaining 70 wanapata mbili, wanapata finance costs na income tax. So ndio wapite lazima at least this 6. So if you get the 6, you are okay. The main thing they are examining is that the 6 months is what they are up to. There's a question I don't want to do, but I'm sharing with you a solution right now, but I want us to analyze. So go to 2017. There's a question in 2017. I just want us to analyze. I share with you the solution, then it will be fine. I hope, we are really focusing on this disposal. I hope they will bring in exam. Do we have overseers here? Overseers? They are pointing at you. Can you tell us in advance instead of struggling? Yeah? The see some over. Overseers. No, those who see in advance. They're called seers. I got the question, December 2017, question 1B, page 83. Page 83. Pastor has said he's a prophet. So can you tell us where to check? Now, please run your handouts. Some of your handout properly. Especially kumeandikwa integrated reporting, management, discussion and analysis, mambo SMEs. Read that handout properly. Read and read and read and read and read. And by the way, what is the best time to read the file? Now, unanga saa zingine tumepanda matatu ati mtu anasoma. hapo mbele ati anasoma FR, ana calculator, ana hata passport, amebeba tu kitabu. Unaweza soma FR ati unaangalia kitabu ati NCI here. It can't work. What is the best time to read FR? The best time, I know you will dispute, but proven, the best time to read the computation paper is that time. Hiyo ingine inakuanga, that is the best time. That is the best time to read the FR. The environment is very calm, then you are able to talk. You know, they say a good reader is someone who reads while talking to himself or herself. You say, tell us NCI, what about receivables? Lazima kama unasoma na earphones, ama unasoma kwa ofisi mkubwa akikuja unaficha chini. Hiyo kitu hizi songa. Mchana sasa ni kuconfirm tu vitu ulikuwa unasoma. This is the best time to read. Hii ni moja kama nasoma hiyo time. Kuamka ni 7. So I want us to check this question, then I'll tell you what is happening. This is the best time to read by the way. And they say that if you do something for 21 days, then it becomes habit. So if you practice something for 21 days, it becomes part of you, of which if it elapses, you feel you are sick. Like unaona when umekuja class, wacha mfunge. You know you miss coming to itafika time ya class unashtuka something is not. Itafika jioni atumeenda nyumbani. There's something not adding up. So itakusumbua for like 7 days then. So ukisoma hii for 21 days, ukifika hiyo tu, you don't even require alarm. Unajikutanga tu umeamka. So utaanza kusoma leo. No, but also people are created differently. Yeah? There are people who can read well at night. Some people are morning people. Like me, I'm a morning person. Usiku, sasa nasoma usiku. Ukikula. Hata wewe kukula na kusoma zitaanza endanisha hivi, sio zikigongana. Let's read this question for purposes of time. James is saying this is the best time for theory. Or he's asking what is the best time for theory? Theory, which is the best time for theory? Hata hii time bado. Cramming inaingianga hii time. Sasa hapa mchana. Sasa hapa usiku. Mpaka tu. The following statement of comprehensive income relates to W and its first T companies, S and F, for the year ended this statement of fine. So we have WSF. So also they have other comprehensive. So when there is other comprehensive, please make sure this thing happens. W Limited hold 60% holdings in S on 1st April 2016. Ebu underline hiyo, SACCO 1st April 2016. Disposal inakuwa all about period. The purchase consideration was agreed at 9, no problem, of which 600 was paid in cash. The balance was satisfied by immediate issue of 5% bond. S Limited net assets at a fair value of 14. As at this, okay, represented by what? Equity share capital of 775 and retained earnings of this. It was decided to apply the proportion of net assets method to calculate goodwill on acquisition. No impairment loss on goodwill arose during the year. So hapo kwa purchase consideration wana confused too bure. They are telling you the agreed purchase consideration was 9, of which 600 was in cash, then the balance was the bond. We will calculate goodwill, wachana na hiyo mambo ya balance. The fact remains the purchase consideration is how much? 900. Chukua hiyo 900 and the net assets, what are you story mingi? Net assets is 1400. Umeiona? Yes, so hiyo story mingi, wachana nayo. Number 2, W sold its entire, and I the word entire. Umeuza F yote. Its entire 60% equity holdings in S on 31st March 2017 for how much? 1150 million in cash. No entry had been made to reflect this. Will make. W owned 90% of equity of F since incorporation. No goodwill arose on this acquisition. There were no retained earnings in existence as at the date of it. No problem. During the year, W sold goods to F for 15. These goods were sold by W at a markup of 50%. Here, 50% on cost. 3/5 of these goods remained in the inventory. An amount of shillings, only shillings. An amount of shillings 4.3 million remained outstanding to W in respect of this good. So remember, unrealized profit, which you can calculate. So at this stage, those ones I know they are not issues. On 1st March 2017, F declared an interim dividend of 9. W has recorded its share of these dividends. No other dividends were declared by the group companies, no problem. All expenses and gains are assumed to accrue evenly through the year. Evenly means proportionately. No new equity capital was issued by any group. Sour. Interest on the 5% was payable in arrears. No payment had been made, no problem. Required, the gain stock loss on disposal of shares in S, of course consolidated, then consolidated statement of comprehensive income. So what I want us to analyze is the how do you consolidate, but I'm sharing with you the answers to this. Don't go to the answers before you do it yourself. So, and I'm going to work it out. Don't expect it immediately. So when is the year ending? 2017. So that one starts on 1st April 2016, correct. When was S disposed? No, but it was acquired when initially? When the question started? W bought 60% equity as on 1st April 2016. Oh, before. Oh, Numerica is sound. It was acquired exactly at the beginning of the year. Yeah. When was it disposed? Note number 2. It was disposed on 31st March. Yes. It was sold there. When was F? F was acquired when? Long time ago. So how are we going to do the P&L? They sold entire. Kila kitu iliuzwa. Na imeuzwa lini? Unadi yote. There is no apportionment. So the rule is when a subsidiary is disposed of entirely, not even entirely, even partially at the end of the year, then there is no apportionment. You take it in full. But coming imekuwa entire hapa katikati, you bring proportionately. That's how. Yes, that is the only issue there. If it is disposed entirely at the end, no apportionment. Also, that one applies if disposed entirely at the beginning, you ignore it in full. So at the beginning, so it will not appear. But if they bring it here, you will take. So here we'll take I'll take W plus S plus what? There will be no issue at all. So I'm sharing solution to that. Whoever did this one and writing it. So I'll just copy it nicely, then I share with you. Meanwhile, you can also attempt. So our question, there's a question I want us to do, which I consider to be complex, and I consider it to be nice. 2016, there's a good question there for us. Right, May 2016. May 2016. So that's a question for Monday. May 2016. May 2016, question 1. May 2016, question 1, page 98. Question 1, page 98. So let's be punctual on Monday. I know it's a very long question, very long. So let's be very punctual, then we scale it. So that one the answer will share before Mulale, before you sleep. So then someone is asking, what about the balance sheet? Though we have not been asked of the balance sheet, how would we have got, assuming this question, they want the balance sheet part of it. How do we go about it? How do we consider the balance sheet? Do we bring the S assets and liabilities? Do we consolidate for them? We bring the assets in the books. What was your financial position on that date? Yes, no. Check it even in the audit. In the audit perspective, post what events, subsequent whatever. Yes, as of the balance sheet date, were those assets present? Of course, yes. The effect will be felt from the next financial period. So you will have to consider. You will consider all those assets because as at that date, as at the balance sheet date, you had those assets. So it will affect the next financial year. So you'll consider them in full. Someone is asking, kesho kuna class? Hebu mjibu hiyo. Wanasema kama kawaida. But we revised the time. So the time was revised. Yes, we start at 7:30. So you need to revise. Ama mnataka tuanze 11? So Mutua is proposing we start at 6:30. Then yeye ndio anakuwa number 1 tuamka. No, 7:30 is quite ideal. 7:30 is ideal for us. Ndio tumalize mapema. In fact, I counted them. We counted for exactly 5 Sundays. 5 Sundays. I'm even praying God can he others 8. Because zile vitu zimebaki hapo. Hatuwezi hata jaribu. Hata kidogo. Actually, I was to travel today, but I've cancelled the traveling because of that class. Very crucial and very critical. So we just have to come. So we have 5 weeks to 5 Sundays to go. That's how. Thank you. Have a nice weekend.